So section 4 is about correcting current period's accrual errors. Accrual errors, that means something accrued, but probably was an error in regards to recording those accruals. There are a few problems here. We can go over them. Let's see. On August 1st in 2020, your company borrows $100,000 and that's a 5-year note with an annual interest rate of 8%. Okay, $100,000 borrowing, 5-year note, interest rate 8%. That's on August. Principal and the accrued interest will be paid at maturity. In January of 2021, before the books are closed, you discovered that no interest was accrued for 2020. But we borrowed in August of 2020, right? So August is included because it's August 1st. So August, September, October, November, December. That is how many months? 5 months, August, September, October, November, December, right? So if in January of 2021, you realize that still this adjusting journal entry is not recorded, still it's time because your financial statements is not prepared yet, your books are not closed. Normally in January, companies are doing the closing entries to see what was supposed to be recognized. They prepare a worksheet and then they work on the worksheet and they do all the closing entries. That's a good thing about having a worksheet that suggests all those adjusting that needs to be done. And after adjusting, you can prepare financial statements. After financial statements are ready, then you can do the closing entries. So it's still time. No, it's not that much late. So we can recognize these adjustments. And we multiply 100,000 times 8% times 5 months out of 12 months. That's $3,333. You record the interest expense and you record the liability because you didn't pay yet, right? So here says principal and all accrued interest will be paid at maturity. And it's a 5-year note. So still we're not going to pay anything, looks like, but at least we need to recognize it. Okay. And if you don't do it, it will be, misstating the facts, because if you don't record the expense will be understated. And if expense is understated, that means the profit, net income, will be understated in the income statement. And if the profit is understated in the income statement, then the retained earning in the balance sheet will be understated too. And if you don't record this liability, the liability will be also understated. Make sense? So one more time, let's go over this. So if we don't record the expense will be understated. That means profit will be overstated. If I made it wrong, I'm sorry about that. Let's do it again correctly. So if you don't record the expense will be understated. If expense is understated, that means profit, net income, will be overstated. If profit is overstated, that means retained earning will be overstated in the balance sheet. And higher overstatements of retained earning, and you will see also on the liability area, if you don't record the liability will be understated. So it's going to mess up the whole thing, right? Okay, so here is the section B, which I just explained. here I put another question. What is the journal entry for December 31st of, let's say, 2021, the second year? Remember, we borrowed this in 2020. So my question is, okay, in second year, which is December of 31st of 2021, what would be journal entry? And my answer will be what? $100,000 borrowing times 8% times 12 months out of 12 months. This is the whole year, right? The second year is the complete year. The first year was borrowed in August, but second year is the whole year. So that's $8,000. So for the second year, you need to record an adjusting entry to recognize interest expense, $8,000 debit, and interest payable credit. What is the balance of interest payable as of December 31st of 2021? That's my second question. I'm just trying to add a little bit more trick to it. So imagine I gave you this question and I have a multiple choice question and saying, what is the balance of interest payable as of December 31st of 2021, the second year? And I gave you a few choices. And your answer should be $11,333. Interest payable as of December 31st of 2021, the second year is $3,333, right there. And $8,000 for the second year. So the interest payable balance is $11,333. So I can easily give you this question and put a multiple choice and ask you this, right? Any question, please, on problem number 1? Okay. Let's go to problem number 2. On May of 2020, your company borrows $100,000 and signs a 10% 5-year note agreeing to pay the principal and accrued interest at maturity. Again, it's 5 years, 10%, $100,000. In January of 2021, before the books are closed, you discover that no interest was accrued for 2020. Again, you see, it's a mistake. It's an omission, right? It's omission of recognition of accrued interest expense. But fortunately, you figured out this in January before the books are closed. So still not too late, right? So you can definitely fix it easily to recognize the adjusting entry. So 100,000 times 10%, that's $10,000. But that's on May, right? So how many months is that? January, February, March, April, May. May, June, July, August, September, October, November, December. That's 8 months. So 8 out of 12. So 100,000 times 10% times 8 out of 12. That gives you $6,667 of interest expense to be recognized. That's a debit. And interest payable will be credited. How about if you don't do this? If you forget the whole thing, then you're going to mess up the financial statements. So if you don't record the expense, interest expense, the expense will be understated. If expense is understated, then net income will be overstated. If net income is overstated in the income statement, then in the balance sheet, eventually your retained earning will be also overstated. How about this liability if you don't record it? If you don't record liability, then liability will be understated in the balance sheet. Make sense? Okay, good. Let's do one more. On July 1st of 2020, your company lends a supplier $10,000 at an annual interest rate of 12%. With principal and accrued interest due at the end of 3 years. Okay, so June, July, August, September, October, November, December. That's 6 months. In January of 2021, before the books are closed, you figured out that interest was not recorded. So because books are not closed, still is time to do it. So here we go. We record $10,000 times 12% times 6 months out of 12 months. That's $600. So interest receivable will be recorded as an asset for $600, and interest income will be credited as a form of revenue, interest income. If you don't record this interest receivable, then your asset in the balance sheet will be understated. Okay? And if you don't record this interest income, then your income in your income statement will be understated. And if the income is understated, then net income will be also understated. If net income is understated, then in the balance sheet, retained earning eventually will be understated also. And here is the answer to section B, which I just explained. Very good. Let's move to problem 4. On January 1st of 2020, your company sublets a warehouse space to James for $500 a month. James' last rent payment was for October 2020. So up to October, we got everything, no problem. In January of 2021, before the books are closed, you discover that your company neither received nor recorded rent for November and December. So for 2 months, we never received rent, we never recorded anything, and we need to record that, right? So 2 months is $1,000, right? Rent receivable should be recognized for $1,000. That's increase in asset. And rent revenue will be credited for $1,000. That's an increase for revenue. Okay. Let's say in January of 2021, they receive rent for 3 months. What is the journal entry? So let's say in January, finally, we received after calling them several times, they send us a check for $1,500 for 3 months that they're supposed to pay. So we record the cash that they send us, that's debit, to increase asset. We close the rent receivable that we recognized for November and December. So that's closing of the liability. So liability will decrease. And we record the revenue for month of January of 2021 for $500. So that will be our journal entry. This part, I made it again myself just to see if you can figure out what the answer might be when the payment is received. Hopefully it makes a little bit more challenging. And in section B says, if no correcting journal entry is recorded, how the 2020 income statement and balance sheet will be affected. So let's go one by one. If you don't record the rent receivable, your asset will be understated in the balance sheet. If you don't record the rent revenue, then your revenue will be understated in the income statement. And if revenue is understated, That means net income will be understated. And if net income is understated in the income statement, then eventually in the balance sheet, retained earning will be understated. Make sense? Okay, let's go problem 5. On April 1st of 2020, your company sublets office space to Babbitt. Okay, so $1,000 a month. And lease runs from April of 2020 all the way to November of 2020. Okay, so far so good. While preparing the trial balance at the year end, you see that December rent was accrued for Babbitt, even though the lease expired on November. So someone, one of your bookkeepers, recognized, the rent revenue for December, but December is not in the contract. The contract is up to November, so that's extra, right? So what is the correcting journal entry anyway to fix that unnecessary recognition of income? So to recognize that, you reverse whatever the bookkeeper did by mistake. So you debit rent revenue by $1,000 to reduce the rent revenue. And then you credit rent receivable to increase the rent, to decrease the rent receivable that your coworker did by mistake. So you reverse the whole thing. So revenue goes down, receivable goes down. If no correcting journal entry is recorded, how are the 2020 income statement and balance sheet affected? You're going to mess up the whole thing. Why? Because if you don't reduce your revenue, then your revenue will be overstated. That means net income will be overstated in the income statement. And because of that, retained earning will be overstated in the balance sheet. If you don't reduce receivable, then the asset will be overstated in the balance sheet. So technically, the whole thing will be a mess. Any question? You're good? There you go. In January of 2021, before closing the books for 2020, you noticed that the December 2020 utility bill of $600 was neither paid nor recorded. And that's a very common thing. So if you have a utility bill, normally, you need to recognize it by end of December because that belongs to 2020, right? So what is the correcting journal entry? So books are not closed, that's fine. So you can record the journal entry still by recognition of debiting utilities expense, that's $600, and recognition of liability by $600. Okay, so expense goes up, liability goes up. If no correcting journal entry is recorded, how would the financial statement be different? So line by line here, if you don't record the expense, expense will be understated. That means profit, net income will be overstated in the income statement. And if the profit is overstated in the income statement, then retained earning will be also overstated in the balance sheet. If you don't record the utilities payable, then liability will be understated in the balance sheet. Okay. Section 5 is the last section for this mastering correction of accounting errors, the red book. For 2020, your company purchased $2,000 of supplies and books the amount as an asset, which is normal. Normally, when you buy supplies, you record it as debit supplies, credit, accounts payable. And end of the year, you do an supplies room count and see what is left out of that supplies. Whatever is left is unused. Whatever is missing, it's used. So you have to record supplies expense for the missing part. As you prepare the trial balance on December 31st, you see that there is no 2020 supplies expense so far. A quick physical count reveals $700 of supplies on hand. So you had $2,000 of supplies, now $700 is left. So to imagine this is like no beginning supplies. So no beginning supplies plus 2,000, available supplies is 2,000, minus 700 left over, then the difference is 1,300 used. That's base. Remember, beginning added, available, subtract end. So beginning is 0 plus 2,000 added, available is 2,000, end is 700, so 2,000 minus 700, that means 1,300 is used. So supply expense will be debited to recognize the expense of supplies that we used, and supplies on hand will be credited to reduce the asset by $1,300. If you don't do that, what would happen? If you don't record the supplies expense, then expense will be understated. If expense is understated, that means income is overstated in the income statement. And if income statement is overstated, then retained earning will be overstated. Also, if you don't record the reduction of asset, then the asset in your balance sheet will be overstated also. Okay. Number 2. On March of 2020, your company prepays $1,800 to rent equipment for 12 months. And you book the amount as an asset, which is prepaid rent. A review of year-end adjusting entries shows a debit to rent expense and credit to prepaid rent for $1,800. But that's for 12 months. You did that on March. So let's count it. March, April, May, June, July, August, September, October, November, December. That's 10 months. You can't recognize the whole thing as rent expense. You need to recognize only 10 months of rent expense. So rent expense for 10 months is only $1,500, which is $1,800 divided by 12 times 10. $1,800 divided by 12 is $150 a month. $150 a month times 10 months is $1,500 rent expense. That means $300 of rent expense must be deferred to next year. So the correcting entry would be what? So I hope you have a paper right now, and I hope you are posting this to the T account so you can understand what's going on. So what you need to do is to reduce the expense. So in order to reduce the expense that you recognize too much, you have to credit expense, right? Credit expense to reduce expense. And after reducing expense, you put that in prepaid rent. So now your T account looks good because you have a prepaid rent showing $300 in it instead of zero, and rent expense will be reduced by $300. Make sense? So if you don't do this, your expense will be overstated. You are you're recognizing too much expense. And if expense is overstated, that means profit will be understated in the income statement. Net income will be understated. And if net income is understated in the income statement, then retained earning will be also understated in the balance sheet. How about prepaid rent? If you don't record the prepaid rent proper amount for $300, then your prepaid rent as an asset will be understated in the balance sheet. Make sense? So someone did a wrong journal entry here, and that messed up the whole financial statements. And your job is to fix this adjusting entry that was done by mistake, hopefully. Okay. In number 3, it says on June 1st of 2020, your company takes out a 1-year insurance policy for $3,600. Okay. And prepays the entire amount, recording the amount as asset, which is prepaid insurance. So the journal entry is prepaid insurance debit, $3,600, cash credit, $3,600. At the end year, I suggest put that in the T account in your notebook so you see what's going on. I just told you the journal entry. So journal entry was what? Debit prepaid insurance, $3,600, credit cash, $3,600. At the year end, 2020, you discover an adjusting entry that records 1-year insurance expense of $1,800. So that's June. June is included. July, August, September, October, November, December. That's only 7 months, right? So $3,600 divided by 12, I think that's $300 a month. $300 a month times 7, that's $2,100 insurance expense. That's what we need, right? $2,100 insurance expense. But here it says at the year end, you discover an adjusting entry that records 1-year insurance expense of $1,800. But we don't need $1,800. How much do we need? We need $2,100. $1,800 insurance expense is not good enough. You need $2,100. But someone did $1,800 already. Let's say your bookkeeper. But you figure out that $1,800 is not enough. You need $2,100. So all you need to do is just add another $300 of insurance expense. So here we go. We add another $300 of insurance expense. That's a debit. And we reduce the prepaid insurance by $300. So now insurance expense is good because someone did $1,800 and you add another $300 and that's equals to $2,100. That's it's supposed to be. Now the question is, how about if you don't do it? If you don't add insurance expense and you don't recognize that additional $300 of insurance expense, then your expense will be understated. If expense is understated, then net income will be overstated in the income statement. And if the net income is overstated, then retained earning will be also overstated in the balance sheet. Prepaid insurance. If you don't record prepaid insurance, then prepaid insurance will be overstated as a form of asset in the balance sheet. But here we reduced it to make it right. But if you don't, then prepaid insurance asset will be overstated. Make sense? And it will make more sense if you read this and you post everything in the T account and then post the correction in the T account, and you will see that you end up with exact insurance expense that you need to have, which is $2,100. Number 4, on May 2020, your company takes out a 2-year insurance policy for $2,400 a year and pays the entire $4,800, recording the amount as an expense. So the journal entry was debit insurance expense $4,800, credit cash $4,800. Please do this journal entry on your T account so you see what you have. So you have $4,800 of insurance expense debit and $4,800 of cash credit. At the year end of 2020, you discover an adjusting entry defers $3,600 of insurance expense. So you see someone deferred the insurance expense, that means credited insurance expense for $3,600 and recorded that as prepaid insurance. Now you are thinking, okay, how much insurance expense do I need anyway? So let's calculate that. You purchased this on May, so it is May 1st. So May is included. January, February, March, April, May. So May, June, July, August, September, October, November, December. That's 8 months of insurance, right? So $2,400 divided by 12, that's $200 a month. $200 a month times 8 months expired, that's $1,600 of insurance expense, right? You need to have $1,600 of insurance expense. So I think this is a little bit complicated, so it's better if I show you the T account myself. How about that? So here is the problem. This is problem 4 that we were trying to cover. So on May 1st, company takes out 2 years insurance policy for $2,400 a year and prepays the entire $4,800 as an expense. So here is the cash account. We have a lot of cash, and we pay for the $800. That cash goes out of pocket. That's a credit, and we record insurance expense in this scenario for $4,800. So far, so good. But at the end of the year, the insurance expense should be only for 8 months, 8 times $200 a month insurance. So insurance, how do you know that? So $4,800 divided by 24 months, that's $200 a month times 8, that's $1,600 insurance expense. But how much insurance expense do we have? $4,800. That's way too much, right? So you have to adjust that. It says at the end of the year, you discovered an adjusting entry defers $3,600 of insurance expense. So you look at the adjusting entry, you see that one of your bookkeepers, deferred $3,600 of insurance expense, and he put it in prepaid insurance as an asset. So expense went down, asset went up, and now because of this, you have a balance of 48 minus 36. How much is it? 48 minus 36. Let's calculate so we don't make mistakes. So 48 minus 36, that's 1,200. So far, so good. And insurance expense showing 1,200. But how much insurance expense you need really to have? 1,600. That's not good. So how much more do you need here? You need another $400. So you need to add another $400 right here to add the expense to make it 1,600. That's a debit. So you credit your prepaid insurance by 400. So now expense ends up to be 1,600, which is perfect. $1,600 insurance expense, and your prepaid insurance from 3,600 goes to 3,200. That's your correction. So debit insurance expense for 400, credit insurance, prepaid insurance for 400. You see, by doing the T account, I know what to do. So if I'm reading this problem, I would never, ever do anything on this problem without creating this on my paper. I will not choose the correct answer. If it's a multiple choice, I will not do anything. Absolutely not. The only way I'm gonna choose the correct answer is after this thing. Got it? So without T account, do nothing. Okay? If there is no question, now I'm gonna continue. I'm saying, okay, if we don't do this, what's gonna happen? If we don't do this, our expense will be understated. 1,200 will be understated. If expense is understated, then net income will be overstated. If net income is overstated, let me put it in the... Okay. So if expense is understated by only 1,200, so expense is understated, that means net income will be overstated. If net income is overstated, then retained earning in the equity will be overstated. If retained earning in equity is overstated, look at the prepaid insurance. That's an asset. Asset previously was 3,600. So 3,600 is more than 32. So if you don't do correction, your asset will be overstated. So yes, equation is still equal, but asset is overstated by $400, and equity is retained earning in the equity is overstated by $800. What is in the retained earning? Capital and retained earning, right? In the earning equity section, we have retained earning and capital. Capital is not changing, but retained earning will be overstated. So overstated retained earning, on the other side, overstated of asset. Okay. On July 1st of 2020, your company sublets warehouse space for $600 a year. 600 divided by 12, that's $50 a month, starting July 1st. ABC takes a 2-year lease and pays $1,200 upon signing. Okay, so ABC is the tenant for 2 years, pays $1,200. which you record as liability. So what's the journal entry? The journal entry is debit cash, 1,200, credit unearned rent revenue, 1,200. So credit cash, 1,200, and credit unearned rent revenue for 1,200. So I'm gonna again go to my T account. I'm gonna write cash, and we received $1,200. That's debit cash. Credit unearned rent revenue, and that's a credit of $1,200. At year end of 2020, you discover that adjusting entry recognizes $600 in rent revenue. So someone recorded $600 of rent revenue. Is it correct? Let's see. July, August, September, October, November, December. That is at the year end, you discover that adjusting entry recognizes $600 in rent revenue. And that's 6 months. July, August, September, October, November, December. That's 7 months, 6 months. So 6 months times 50, that's $300. So $300 of rent revenue should be recognized, right? At the year end 2020, you discovered that the adjusting entry recognizes $600 in revenue. That's too much. So what is the correcting entry? So rent revenue should be only $300, which is just 6 months, July through December. But $600 was recognized, which is too much. So that means we need to reduce the balance in the rent revenue by $300. So let's recognize first what that wrong adjusting entry was anyway. The wrong adjusting entry was to reduce the unearned deferred revenue by $600 and recognition of rent revenue by 600. But that was the wrong one, right? It should be just 300. So I'm gonna show you again my camera if possible. So stop sharing. So this is what I was writing when I was reading it. So cash was debited, unearned revenue was credited. By end of the year, we should recognize 6 months times 50, which is $300 rent revenue. But someone in our company recorded $600 of rent revenue by doing credit rent revenue debit liability. Okay, in this scenario, the liability is only $600, which is not good. And revenue is $600, which is also not good. We don't want rent revenue of 300. We want just for 6 months times 50 is 300. So how do you get from 600 to 300? How do you do that? You need to get from here to here. So in order to do that, you need to debit rent revenue. And if you debit rent revenue, then you credit unearned rent revenue. So $600, 300, so 600 minus 300 is 300. So you debit rent revenue by 300 to reduce it to $300 end balance, and you credit your liability by $300, and your liability will increase to $900. Cool. So by doing this, your unearned revenue goes up, liability goes up, and your rent revenue goes down. If you don't do this properly, so this is your asset equals liability plus equity, and in the equity you have capital and retained earning, right? So if you don't do this correction, your liability will be 600 instead of 900. So your liability will be understated. And if you don't record this in the balance sheet, and if you don't correct this, your rent revenue will be 600 instead of 300. So your rent revenue will be up. If revenue is up, then net income is up, overstated. If net income is overstated, eventually your retained earning will be overstated. As you see, your asset is no change, but your liability will go under and your retained earning will go over. Your equation is still equal, but financial data that you have in your financial statements is wrong. So that's number 5. Let's go to number 6. In number 6, it says on October 1st of 2010 or 2020, your company sublets warehouse space for $900 a year to DEF, which pays in full upon signing, and amount is recorded as revenue. So let's do that. Create your T account, please. I'm doing the same thing. So my cash is debited for $900, and it says upon signing is recorded as revenue. So rent revenue will be credited for $900. At the year end of 2020, you discover an adjusting entry that defers $300 of revenue. Defers $300 of revenue, that means someone debit the revenue for $300 to reduce it, and someone credit $300 as unearned rent revenue. Unearned rent revenue or deferred rent revenue is the same thing. It will be credited. Okay. Now, that's October, November, December. That's 3 months. So first of all, you need to know what's the rent revenue that you need to recognize for only 3 months. So 3 months is 900 divided by 12 times 3 months. 900 divided by 12, whatever it is, times 3 months, that will be 3 months of rent, which is, I believe, $225, 3 months of rent. That's $75, I believe. $75 a month. That's what you need to recognize for 3 months. Okay? But someone here recorded rent revenue for $600. That's a lot of rent revenue. Because if you defer only 300, then out of 900, $600 rent revenue will be on your T account. And that's not good, right? So in order, but how much rent revenue do you want? You want only $225. You don't want 600, right? You want $225. So to recognize the correct amount, only $225 is needed. Your company should have deferred $675. So $900 is the whole prepaid rent, minus $225 that needs to be recognized as revenue. So you have to defer $675. But someone did how much deferring? Only $300. That's not good enough, right? So you have to defer another $375 to make it right. So in order to see this, you see it's complicated, right? So in order to see this, you need to look at your T account. So I'm going to show you my T account now. Okay. So someone gave you $900 in advance and you record that as rent revenue. Then you saw that one of your bookkeepers deferred $300 of rent revenue and put it as unearned rent revenue or deferred rent revenue and created a liability. By doing that, you have a rent revenue of $600, which looks okay, right? But then you do some math. You say, okay, $900 divided by, I believe, 12 months. That is 900 divided by 12. That is $75 a month. 75 a month times October, November, December. That's 3 months. So that's $225 rent revenue to be recognized. So far, so good. But how much rent revenue do you have? After deferring $300, you have $600 rent revenue. That's not good. You need to have how much? $225. So how do you get from this point to $225? From 600 to $225. So here is the difference. Minus 600. That's $375 difference. So you take another $375 from rent revenue. That's your adjustment. That's a debit. And you credit unearned rent revenue. By doing that, 600 less 375, that's 225 rent revenue. And your unearned rent revenue goes to 675. So your liability will go up and your revenue will go down. So if you don't do this, what would happen? This is capital and this is retained earnings. So if you don't do it, what would happen? Rent revenue will be overstated. If rent revenue is overstated by $375, then your net income will be overstated. And if net income is overstated, then your retained earning will be overstated in the balance sheet. And if you don't do the correction, your liability will be only 300, which is understated. So your liability will be understated. As you see in your equation, asset is no change, liability will be understated, retained earning will be overstated, still is equal, but all mess and useless information. That was number 6. Let's do number 7. On June 1st of 2020, your company sublets warehouse space for $1,800 to GHI, which pays in full upon signing, and then you record it as revenue. So again, I'm going to go to my paper, draw a T account for cash. So we sublet warehouse for $1,800 we received in cash. So cash goes up by $1,800. That's a debit cash. And we record it as revenue, rent revenue, and that's a credit of $1,800. And that's June, July, August, September, October, November, December. That's 7 months. Okay. At the year end of 2020, you discover an adjusting entry that transfers $900 from rent revenue to deferred revenue. So let's transfer that. So debit rent revenue $900 in your T account and credit deferred or unearned revenue as a liability. Now let's count it if it's correct or not. So $1,800, it's a year. $1,800 divided by 12, that is, gosh, how much is that? Let's calculate. $1,800 divided by 12, that's $150 a month. Okay, $150 a month times 7 months, from June, July, August, September, October, November, December. And that is $1,050 rent revenue. That's what I like to have, $1,050 rent revenue. So let me share my screen again. Remember I said without T account you can't do anything? Here is the good example. So here we have cash deposited, rent revenue recorded for $1,800, which is okay if you like to do it that way. And someone deferred $900 from rent revenue into unearned rent revenue or deferred rent revenue. That's a credit. So by doing that, my rent revenue is only $900. But how much rent revenue do I need? $1,050, right? 1,800 divided by 12 is $150 a month times 7 months. That's $1,050. How much do I have? 100. How much do I want? 1,050. How do you get from that point to this point? From 900 to 1,050. So 900 minus 1,050, that is 150. So if I add another 150 as an adjustment, secondary adjustment, that's a credit, and I debit 150 here to my liability deferred revenue. So my deferred revenue goes down to 750, which is correct. And my rent revenue goes to 1,050, which is correct. If I don't do this, what would happen? Capital and retained earning, right? So if I don't record this, my revenue will be understated. If revenue is understated, that means net income is overstated. No, if revenue is understated, that means net income is understated. If net income is understated, that means retained earning is understated by $150. And if I don't reduce the liability to 750, then liability will be overstated by $150. As you see, equation is equal, asset has no change, liability will be overstated, and retained earning will be understated. And net income will be understated. Very good. Okay. So that's the answer for problem 2.7. And now let's go to problem 8, which is the last. Okay. On July 1st of 2020, your company takes out 2 years insurance policy for $2,400 a year and pays the entire amount upon signing, recording the amount as an expense. So here we go. Let's go back to T account draw, please. So cash is, we have a lot of cash, obviously, hopefully, and takes out 2 years insurance policy, $2,400 a year, and pays the entire amount upon signing. So $2,400 times 2, it's $4,800 cash paid. So cash credit $4,800, and we record it as expense. So insurance expense, that's a debit of $4,800. So cash credit, insurance expense debit. So far, so good. At the year end of 2020, you discover an adjusting entry that defers $1,800 by debiting prepaid insurance. Okay, so we debit prepaid insurance as an asset for $1,800 and defers insurance expense by $1,800 to reduce it and defer it to asset for prepaid insurance $1,800. So in that situation, insurance expense T account shows $3,000 of balance. Okay, we did this in July 1st. So July is included. July, August, September, October, November, December. That's 5 months, 6 months. Let's count it again. July, August, September, November, December. That's 6 months. Always count twice, okay, to make sure. So that's 6 months of insurance. $2,400 a year. So let's do that. $2,400 divided by 12 months. That's $200 a month times 6 months. That's $1,200 of insurance expense that we need to have. But how much insurance expense do we have in the T account? Let's look at the T account right now. So here we go. As you see, we debit cash and credit cash and paid the insurance policy and recorded as insurance expense. So far, so good. Someone deferred $1,800 of insurance expense and put it in prepaid insurance. That means insurance expense balance is right now $3,000. But then I do the math. I say, wait a moment, $2,400 divided by 12, that's $200 a month. Insurance expense times 6 months passed, so we should have insurance expense of $1,200. How come I have $3,000 insurance expense? This is too much. So you need to do what? You have to say, I want $1,200 of insurance expense, not $3,000. So in order to get this $1,200, then I need to reduce expense by some dollar amount. That's a credit. And debit, that means deferred to prepaid insurance by some dollar amount. Okay, so 3,000 minus 1,200, that's 1,800. So here we go. 1,800, I'm gonna take it out of insurance expense and put it as prepaid insurance. That means defer that to future time to recognize as an expense. So my insurance, prepaid insurance goes up to $3,600, which is perfect. And my insurance expense goes to $1,200. 3,000 minus 18 is 12. That's perfect. If you don't do that, what's going to happen? So that's your equity. And that's your retained earning in the equity. If you don't reduce your expense, expense will be overstated. Okay, if expense is overstated in the income statement, that means your net income will be understated in the income statement. If net income is understated in the income statement, that means retained earning will be understated. Okay. And asset. If your asset is 1,800, it's understated. It should be 3,600. So if you don't do this, your asset will be understated. So look at the equation. Asset is understated on the left side. Retained earning is understated on the right side. Equation is equal, but financial data is wrong. Make sense? And this is the answer for problem 8, which we just solved. Okay. So make sure you get ready for exam 2 and submit your exam 2 questions before the due date. Okay. Have a wonderful day then. Bye-bye.